Today we will do Chapter 2 together. For Chapter 2, our topic is International Wholesale Banking. Let us examine the chapter outline. In this chapter, we will examine how the explosive growth of securities markets, the intensity of the shift from paper to digital contracting, settlement and dissemination of information, and the deregulation of financial services on both sides of the Atlantic have combined over recent decades to push most leading commercial banks toward investment banking and internationalization. What is the concept of wholesale banking? Three main factors affecting the fundamentals of financial intermediation contributed to this expansion. The first one is significant regulatory changes. Second one, an extraordinary acceleration in the use of digital technology. And the third one is the explosive growth of securities markets. Why we need the correspondent banking? Let us firstly examine the international trade finance. The settlement of an international commercial transaction can range from a cash payment in advance, which is risky for the importer, riskless for the exporter, to a deferred payment until final sale of goods, with ability to return unsold merchandise by the importer, risky for the exporter, riskless for the importer. So, in order to lower these risks, a correspondent banking is needed. What is correspondent banking? Banks step into the middle of this push-pull of risk between exporter and importer to provide the type of financial settlement and credit support solution which best meets the objectives and constraints of both parties. The letter of credit is used for the import and exports. You can analyze an example for letter of credit in the book part of chapter 2. The term lending, credit risk, increases not only as a function of the amount of the exposure a bank has to be customer, but also as a function of the tenure of the loan, which we just talked about it before, the maturity of the loan. The banks should seek ways in which to combine efforts to accommodate the larger and longer-term loan demands of their customers. So, where can the banks find longer period of funds or the sources? Because as we mentioned before, the deposit maturities are maximum at 1 year. So you don't know if the customer will continue with you or not. Let us remember what are we called LIBOR and SWIFT again, because for the international banking, these are the important ones that are used for the loan pricing, LIBOR, and SWIFT for the international trade. London Interbank Offered Rate set the criteria for the euro currency interbank market, challenging flows of capital between international banks, and mostly for the loan agreements. You can see the LIBOR plus, for example, 2% or 3%. These are the pricing of the banks for giving the loans. In other words, the banks are just using some funds from the other banks or outsources, and they have to put LIBOR plus 2 or 3%, which are their profit. These percentages are the difference for making profit, cost, and the loan price for the bank. SWIFT, Societe for Worldwide Interbank Financial Telecommunications. These are the common standards for financial transactions. Another lending is global syndicated lending. The consolidation of the euro-dollar market in London in the 1960s was a fundamental stepping stone for the development of the global syndicated loan market. London branches of foreign banks to fund themselves at the London Interbank offered rate to provide medium-term LIBOR-based credit facilities to major corporations and governments around the world. Secondary markets for syndicated loans. Contractual agreements have always made possible the transfer at a premium, par or discount of a loan from one bank's balance sheet to another's. Loan syndications and trading associations with headquarters in New York, established in December 1995. This initiative preceded the establishment in London of the Loan Market Association, formed in middle 1996. So the banks has to use syndicated loans because they have to find some more funds or some sources for the loaning the customers. Another important part is project finance for the international banking. The difference between project finance and conventional long-term corporate lending is that in project finance, the borrower is not a corporation with a financial history and significant assets of its own, but a newly formed company created for this specific purpose, special purpose company, or engaging in a capital intensive and very specific economic mission. In other words, like energy, transportation, telecommunications, mining, and real estate projects. So project finance is different from conventional long-term corporate lending. Please don't forget that, because for the project finance, you cannot find any historical financials for this kind of companies. So for the project finance, only the company is established for energy, transportation, telecommunications, mining, real estate projects. A typical project finance structure brings together participants with different objectives: equity investors, service providers, and project lenders. So you don't have a similar intersection like the customer and the bank. You are responsible for the other parties too. The project lenders are the banks and other financial institutions providing debt financing to the venture on the basis of its cash generating capacity, and additional credit support arising from the contractual obligations of the service providers, limited recourse to the project sponsors in the form of capped guarantees, temporary sinking funds, etc. The banks have to find different sources, and this just caused in the international banking to the establishment of these different financing companies also. So let us check out what are they. The different financing sources, the debt portion of a project finance structure may bring together different financing sources such as commercial banks, development banks, insurance companies, dedicated investors, for example, infrastructure investment funds, and other institutional fixed income investors. What is the international investment banking? The primary role of an investment bank is to design and realize financing structures that satisfy the objectives and constraints of both the issuers and investors. While having issuers and investors as their primary clients, investment banks can trade also for their own account with other market participants or counterparts. And what are the revenues of investment banks? Securities underwriting, secondary market making in these securities for investors, structuring of and market making for risk management instruments, which we call them derivatives, proprietary trading in securities, commodities, foreign exchange and derivatives, credit, typically short-term and secured for issuers, investors, and trading counterparts, mergers and acquisition advisory services. You can read the details in the book chapter 2. Here we will just analyze the important ones in our slides. Global equities, which we call them another name as derivatives. A derivative is a financial contract whose value varies in response to changes in the price of an underlying asset that can also be traded in the marketplace. Why we need these derivatives? A derivative exposure can be a hedge, a sacrifice of potentially higher future returns to reduce risk, or a speculative trade, an uncovered calculated risk taken in the expectation of a financial gain. For this chapter, you have to read more for the derivatives because I believe in that you have seen these ones in other courses and the participants also. The mostly common one is like swaps, futures, options, and these ones are differ from each other according to the maturity, according to the contracts especially. So let us just look an example for the derivative, which is mostly common in the world. Classic examples of derivatives are swaps, commitments between two counterparts to exchange future stream of cash flows. For example, floating for fixed interest rate. And futures, another one, transferable contracts promising delivery of a defined quantity of an asset at a specified price on a predetermined date. So here you have to know the date and you have to just define the quantity. Derivatives market. We have two mostly known markets for the derivatives. The first one is exchange traded derivatives. The second one is the over-the-counter derivatives. Standardized derivatives contracts such as options and future contracts are traded in organized exchanges. Less standardized, bespoke or tailor-made derivatives are traded over the counter by market makers on these instruments. The last one for merger and acquisitions. Mergers and acquisitions, which we call M&A, are among the most important strategic decisions companies make. It is little wonder that investment banks, as experts in business valuation and financial structuring, should seek to position themselves as dominant providers of M&A advice. Compensation for a bank's M&A advisory services combines a retainer fee, typically capped and often deductible from the success fee, and the success fee payable upon completion of the transaction. We will analyze the merger and acquisitions in chapter 3, and you will see that some of the mostly world's bankers, the biggest ones, try to just make some takeovers and just having to increase their market share in the international banking. Summary of this chapter, we are trying to just under the international corporate commercial banking, we just examined the basic elements of international trade, finance and the mechanisms, the origin, evolution and workings of the international syndicated loan market, the basic elements of international project finance, the nature and workings of global cash management and securities services offered by most international banks. And our second part was for international investment banking, and here we have examined the primary role of the investment bank as agent and intermediary of financing structures, the full range of investment banks' revenue generating activities, derivatives, trading and the roles of investment banks as both market makers for customers and traders for their own account. The recent global trend towards consolidation of exchanges across financial instruments and geographies, and the competitive aspects of cross-border M&A advisory services. This is the end of chapter 2, and we will continue for chapter 3 in another course.